Hello, I'm Susan Graham, and I want to welcome you to the 7th episode of the Beyond Retirement Learning Series. This is sponsored by Senior Edge Legal. I'm a certified elder law attorney based in Boise, Idaho, and today's topic is how to pay for long-term care. Now, I know your goal is to find out information that's useful for you and possibly see if we're a good member for your team. I have three goals. One is to give you information that's helpful for you so that you can have a secure future. And another one is to provide you with free legal forms that everyone needs. And lastly, to show you how to meet up with me if that's something that works for you in the future. To get those forms and to meet up with me and also to evaluate my information that I give to you today, there is a form on the bottom of your page that you can fill out anytime and email that to us. So today we're going to talk about how to pay for long-term care. They're pretty dreadful and frightening statistics in our country. Once somebody passes the age of 65, they have a 70% chance of needing care before they die. I'm talking about care in your home, assisted living, or a memory care unit, or skilled nursing care. And now nobody wants to be in that 70% group, but let's just talk about if that should happen for you. The costs are pretty breathtaking. Care in your home is $25 to $30 an hour for a bath aide or other people to come help you on a regular basis for a few hours each week. If you want 24-hour or need 24-hour care in your home, you don't want to go anyplace else, you're looking at $11,000 to $18,000 a month. Then there's memory care, or you might move to independent living or assisted living. Those facilities cost in the range of $3,000 to $6,000 a month. And then lastly, if you end up in skilled nursing care, you need that in a facility that has 24-hour medical people available. That ranges from $8,000 to $10,000 a month. So let's talk about how you'd actually pay for any of this stuff. Now, one way, of course, is pay it out of pocket. And, you just keep paying until you run out of money. Another way is to pay it with a reverse mortgage. So if you really get down in your money and you still want to stay in your home or provide for your spouse who's in one of those facilities, you can get the equity out of your home by getting a reverse mortgage. I regard that as the last ditch of where you're going to go for resources, but that still allows you to continue to have your home. The reverse mortgage area is heavily regulated, so you don't need to be worried that somebody's going to fleece you on that. Once you're 60, the federal government has regulations about how this works. You can't get a reverse mortgage before age 60. And it depends on your age and the value, the equity value of your home and what region you live in. So that's certainly an option for some people. The advantage of a reverse mortgage is it frees up the equity in your home and you don't ever have to pay it back. So you don't have to pay monthly interest or monthly mortgage payments. Now, when you leave the home or you and your spouse die and are no longer in the home, then of course the home would be sold and that debt will be paid off. But that at least you don't have to start making out-of-pocket payments during your lifetime. Another way to pay for long-term care is to get long-term care insurance. This entire conversation is related to residential care. If you just need help for a little bit, this is not something that should be a great worry. We're talking month after month, year after year need for care. I'm a huge fan of long-term care insurance. And the younger you are and the healthier you are, that's the best time to apply for that kind of insurance. The advantage of the insurance is it covers care in your home or in a facility. And it's triggered under most of the policies once you have a need for two of the activities of daily living. I'm talking about being able to feed yourself, getting up out of a chair, out of bed, being able to dress yourself, being able to take a shower, those kinds of things. You're not going to feel sorry for the insurance company and not make a claim when those events occur. And the advantage of it is, again, it covers all these different places. Plus, it also provides a breathing space for your spouse if you're married, or your kids, or the people who care about you, or even you if you're still competent. It gives you a space to try to figure out what are you going to do in the next step if this is truly a long haul possibility. If you say, well, no worries, I've got a spouse who's going to take care of me, and you have a marriage that, when you got married a short time or a long time ago, you both made that same promise that this is going to last for the good days as well as the bad days. And when the bad days show up, the healthy spouse steps up and does whatever they need to care for the ill spouse. The problem with that picture is that the helping spouse, the one who's not incapacitated and needs the care, is more likely to predecease the one that they're caring for, which is horrible. That means we have a house of cards anyway. We've got one person who really is quite needy and needs care, and another person providing that care. And when the one providing the care collapses and dies, that whole house of cards falls apart. In addition, if you expect your children to be able to do that, that's nice, but that really disrupts their life in unimaginable ways. They lose their employment because they can't be employed and do care for you. They also lose their Social Security contributions. And it just impacts on their life so that they really don't have another life if they're really spending all their time caring for you or another loved one. So long-term care insurance, if you buy that, it provides at least a year's worth or half a year's worth or 3 years worth of coverage. So that gives the people who are supporting you in other ways some breathing space to be able to help figure out what's going to be the next best step for you. If you buy long-term care insurance, I encourage people when they purchase that policy to purchase it and only pay premiums for a limited time period. What I'm talking about, only pay premiums for 5 years or 10 years, something like that. The premiums will be much higher, but you don't want to get a premium notice when you're 85 and the premiums have just gone up and you just say, I can't pay this, I'm not going to do it, I'm going to drop it. That's the wrong time to drop it. So if you pay the premiums over a limited time period, again, the 5 or 10 years, whatever, you pay a slightly higher premium. But when you're done, you're done. It's like a paid-up life insurance policy. You don't have to make any premium payments again. And it also takes away the risk of the exposure of the premiums going up. The life insurance industry has centuries of information, so they know and they can work out the math how to price the life insurance policies so it still covers the people, but the life insurance company makes some money. And the long-term care industry is not that long. It doesn't have that long a history. So it's been pretty common in the last 10 years and more for, yes, they tell you a premium and it goes along for a while. And then after a while they say, gosh, we're not making enough money here. We're going to have to close our doors. So they increase the premium. And they can't pick on you, they pick on everybody in the state if in fact they increase the premium. So you deal with that increased premium and you go along for a while and then they increase it again. That's why I say if you pay the premium over a limited time period, then that cuts out your exposure to that increased premiums after you're done with those payments. Lastly, I recommend that you get a cost of living rider on the policy. So if it pays $100 a day for care this year and you have a 3% rider, it'll pay $103 next year and $107 the next year and so on. You want that because it's just inflation in our world. Something that costs $100 today is not going to cost $100 10 years from now. So again, I'm a huge fan of long-term care insurance because, first of all, it provides for care in your home or in any of these facilities, and also it gives breathing space for you or the ones you care about or that care for you that allows them an opportunity to gather themselves back up after caring for someone for a length of time and then being able to pay for the care or at least subsidize some of the payment for the care and then figure out what the next plan is. The next version of how you pay for long-term care is with government programs. Now, there are two primary government programs. There's the Veterans Program and there's Medicaid. Medicare does not provide anything toward long-term residential care. Medicare is a health insurance program for people 65 and older. And when I speak about Medicaid, that again is for people 65 and older, or it can be for disabled people. Now, let me talk about the VA benefit first. If you're a veteran and you served during, or you're a widow of a veteran, or you're married to a veteran, and that veteran served during wartime. So that means World War II, there are not too many people left from that, the Korean War, the Vietnam War, and the Gulf War, which still hasn't ended. So if somebody was a veteran during a wartime and they served at least one day during that wartime, and they served for at least 90 days on active duty, and they don't have to be on some front line where people are shooting bullets at them. I mean, they could be mopping a floor in Washington, D.C. So they have to have been on active duty one day during wartime, and their discharge has to be anything other than dishonorable. So if it was just a general discharge, or they were, a good conduct discharge, that's fine. Then what happens if, there's an income test, but what we really care about, again, we're talking about long-term residential care. There's an asset test, and almost all my clients fail the asset test. You can have a house, and they don't really care what it's worth, and the stuff in the house, they don't care about that. They don't care about the value of one vehicle. But after that, all the other assets that are owned by the applicant or the applicant's spouse, one of whom has to be a veteran, as I described, those other assets, including retirement accounts, IRAs, Roth IRAs, 401ks, and then their certificates of deposit, their brokerage account, the second car, the cabin, all those sorts of things. When you add them all up, if they exceed more than approximately $130,000, they won't qualify for the veterans' benefits. Some people think, well, that's easy. I'll just give away those extra assets and then I'll apply. Well, the veterans have just changed the laws, and they've said if you give away your assets, you won't qualify for 3 to 5 years, depends on how you do the calculations. Who cares? What I'm saying is the veterans' benefits are nice that they're available. They're tough for most of my clients to qualify for because my clients are middle-class people, and they've done what everybody told them to do, especially with regard to retirement benefits. They've set up IRAs or 401ks or whatever. They've shoved money into those accounts, and then when they take them out, they have to pay a tax, an income tax, but still the balance of what's left over is what gets counted in the VA benefits. The VA benefits that are actually paid, assuming you meet all their tests, including the asset test, the VA benefits are nice because they come and you can spend the money however you want, and they don't ask to be reimbursed when someone dies. But they range from a low of about $1,000 to a high of about $3,000, which isn't really quite enough money to pay for, certainly maybe at home, but certainly not for the memory care or the assisted living, or definitely not for skilled nursing care. So let me talk now about the Medicaid program. The Medicaid program also helps pay for long-term care. And this is a state and federal program, and it's administered by the state. To qualify for this program, somebody has to be over 65, and you have to have a need. I mean, you just can't say, oh, this sounds great, I think I'll apply for this benefit. You can't get this benefit unless you have a medical need for extended long-term care. Again, there are multiple tests, but the asset test is if you're a married person, you get to have a house of an unlimited value, a car of an unlimited value, prepay your funeral with an irrevocable funeral fund. The retirement accounts they ignore. So for you, the applicant, or your spouse, they ignore those. If you're the applicant, you have to actually take out some portion of your retirement account each year and pay it toward your care. But of the other assets, certificates of deposit, brokerage accounts, savings account, the second and third car, the vacation home, the cash value in your life insurance, all that kind of stuff. When that's all added up, if you're a married couple, the healthy spouse is entitled to 1/2 of that whole pile of assets. But they put a cap on that, and the cap is approximately $130,000. So if you have $300,000 in CDs, and that's it, and they're not retirement CDs, 1/2 of that's $150. Well, the healthy spouse can't keep $150. They can only keep approximately $130,000. And the other money needs to disappear, needs to be what's called spend down in this area of the law. So how do you do the spend down, or how do you make that extra money go away? There are lots of ways you can do that. One of them, you can buy a more expensive home. You can buy a more expensive vehicle. Of course, you can buy a dining room set. I had one lady who'd never had a decent dining room set, and she was in her 80s, and her husband was going to go on Medicaid. And she actually bought a $10,000 dining room set, the dining room table, the chairs, the hutch, the bureau, all those kinds of things. So it made her happy. So that was one way to spend it down. Another way you can spend it down is you can actually buy an annuity in the name of the healthy spouse. These rules are a little crazy, so I don't expect you to memorize these. And if you do need to apply for Medicaid, I strongly encourage you to talk to an attorney who knows this area of the law. But if you put that extra $170,000 into an annuity when the couple had $300,000, and I'm going to be sexist and say it was the wife who's the healthy spouse and the husband who's in the nursing home. The wife gets $130,000, so now we got $170,000 on the table. If she goes and buys an annuity and it's all paid back to her in equal monthly installments over approximately a 3-year period, she'll end up with all the money. And then once the ill spouse qualifies for Medicaid, nobody's going to bother the healthy spouse about what she's doing with the money, with the one exception. She can't give it away. If you give it away, then that creates all kinds of problems with being able to get the benefits. And you might be saying to yourself, well, wait, okay, if you have a $300,000 CD and the wife's entitled to $130,000, why bother buying the annuity? Why not just give away the $170,000? Well, again, there's what's called a penalty period under the Medicaid rules. They're not totally stupid, the people who set this up. They say, hey, if you had the money and you gave it away, you can't qualify. You have to ride out what's called a penalty period. And the maximum penalty period is approximately 5 years. So you have to be careful. You can't give things away and then say, oh, okay, now I can qualify. If it's a married couple and they did all that, so, excuse me, the wife held on to the $130,000. She purchased a $170,000 annuity, which got paid back to her over that 3-year period. So now she's sitting on all the cash, plus the house is in her name, the car is in her name, and so forth. All that has to be paid toward the husband's care costs would be his Social Security and maybe pension. That generally is what's paid. And if he has an IRA, it would be whatever the minimum distribution, the required distribution under that IRA would also go toward the care. And when the husband dies, the wife is going to get a letter from Health and Welfare that says, we're so sorry he's gone. And by the way, we've paid $200,000 for his care. And she can just throw that in the trash, because she doesn't have to pay that back. But when the wife dies, yes, that $200,000 has to be paid back to the state of Idaho. It's called estate recovery. And so if there's $200,000 in the wife's estate, that'll end up being paid back to the state. If there's not enough money there, then the state will take whatever they can, and then the balance will just be forgiven. Now, that's really a pretty good program for married people. If you're a single person and you're looking to the Medicaid program to help pay for the costs of long-term care, and by the way, they don't pay too much for care in your home. It's more in the skilled nursing care and some in assisted living. A single person can have a house. The maximum value of the house in Idaho is $750,000. A car, they don't care what the car is worth. And again, you keep your retirement accounts, but you have to pay those, the minimum distribution toward the cost of care. And then you have to be down below $2,000. This is pretty stiff. And if you do that, there is no money there to pay the taxes and the insurance and the maintenance on the house. So most people, when they get in that circumstance, end up selling the home. So it's a big problem. And the one reason I enjoy so much being an attorney is I help people plan ahead so they can figure out how to deal with these issues should they occur. I wish for you what I wish for me. Stay in that 30%. Don't get in that 70% category. But the odds are pretty heavy that you're going to end up in 70%. If we had 70% chances of winning in jackpot every time we went down there, there'd be probably by now a railroad going down to jackpot. We'd all go down with our garbage cans, fill up the money, and come back home. I mean, the 70% odds are real serious, and that's why I give you that jackpot, comparison. So pay attention. Now is the best time to look at it. Consider the different ways to pay for long-term care. Do you have enough money to truly pay for that out of pocket? And even if you do, you may want to consider long-term care insurance if you can qualify for it. Because I've had many clients who were very fortunate and had significant assets. They did not have long-term care insurance. They self-insured, meaning the healthy spouse between the two spouses, just muddled through. But the problem for the healthy spouse is they get worn out and they can't think straight. And one of my clients came in, he was caring for his wife with extreme dementia. He left her alone 3 hours every day so he could play golf and have a good time with his chums, which made me crazy. I offered to him to help arrange to get caregivers into his home to be able to provide adequate care for his wife. He said no, he would take care of that himself. He never did. He died of a heart attack before his wife died, and that created just total chaos. So even though you can self-employ or self-insure, I still encourage you to think about long-term care insurance to get that piece in place so that you can actually buy some breathing space for the healthy spouse. And certainly a mechanism to pay for care. So you pay for it out of pocket, you pay for it with long-term care insurance. If need be, you can get a reverse mortgage against your home to free up some cash. And then you look at the government programs, which are the VA and the Medicaid programs. I hope this has been helpful information for you. I want to share with you that the next episode is going to be about protecting assets for a surviving spouse and your children when you die, so that they actually have those monies and nobody can take it from them. I would appreciate it if you would look at that evaluation form at the bottom and fill that out. One of the best things that I get back from people is they critique me and tell me how I can improve this or what they would like for future programs. And again, if you would like to visit with me or access those free forms, just indicate that and you'll have that information. Thank you for taking your time with me.